Welcome back to the deep dive. So we got that massive transcript from the Q3 2025 earnings call you sent over.
Yeah, it's definitely a beast to get through.
It really is. Reading the whole thing, it's a marathon.
Exactly, especially if you're just trying to pull out the key, the raw data.
Right. So our mission today, we decided, let's be surgical. We're skipping the usual operational updates, all the commentary, and we're diving deep only into the prepared opening remarks from the CFO, Jason Warnick.
Straight to the financial heart of it, no fluff.
That's the plan. Cutting right through to the numbers, the strategy behind them. And the CFO's message seemed really clear.
Yeah, it really centered on two main things: profitable growth, sustained profitable growth,
Yes.
and then diversification.
And these aren't just buzzwords in this case, are they?
Wow.
I mean, the figures he presented were kind of shocking.
No, absolutely not buzzwords. And that context is critical. The whole point seemed to be showing that, look, this growth isn't just growth at any cost.
Right.
It's profitable, it's disciplined, and it's strategic. They're building new financial engines, but keeping the old ones running smooth, efficiently.
Okay, let's unpack this then.
Yeah.
Because the headline number alone is huge. Q3 performance.
Yeah.
Revenue doubled.
Doubled year over year.
And earnings per share, EPS, more than tripled year over year.
Yeah.
That's not gradual improvement. That's explosive.
It really is. And the CFO, he really hammered that home. Another quarter of strong, profitable growth. Revenue doubled compared to last year, hit an all-time high, nearly $1.3 billion.
$1.3 billion in a quarter.
And crucially, margins expanded at the same time. That's the key bit. It's not just about getting more revenue. It's about getting more profitable revenue.
Okay, so that's Q3. What about zooming out? Year to date through Q3.
The trend holds pretty solid. Revenue's up 65% year to date.
65%.
And EPS up 150%.
Wow. Over 9 months. That's
Yeah.
impressive growth. But you mentioned discipline. How does that show up?
Right. So the proof, the real leverage is in the incremental profit margin. That's where the discipline comes in.
Okay.
They delivered 75% incremental adjusted EBITDA margins.
75%. Okay, break that down. EBITDA is earnings before interest, taxes, depreciation, amortization.
Exactly. So a 75% incremental margin means for every new dollar of revenue they brought in this quarter, 75 cents of that basically dropped straight to the adjusted bottom line.
So that's proof of extreme scaling efficiency.
That's it. They figured out how to grow the top line really fast, but the costs aren't growing nearly as quickly.
And the CFO explicitly said that was down to disciplined expense management.
He did, which is, a powerful validation of how they're running things.
Okay, so strong core performance.
Yeah.
But you also mentioned diversification.
Yeah, and what's fascinating here is, just how fast that diversification is happening. This is where it goes from just being a good quarter financially to, a real strategic shift.
Okay.
He announced this major milestone. 2 new businesses.
Right, prediction markets and Bitstamp.
Yeah, both of them surpassed $100 million in annualized revenue, just in Q3.
Each. Wow. Okay, so what does that mean big picture?
Well, think about it. That brings the total number of their business lines hitting that $100 million annualized mark to 11.
11 distinct revenue streams at that level.
Exactly. They're building this portfolio, right? 11 different engines. So if one market, say, hits a rough patch,
They get 10 others.
10 others potentially picking up the slack. That's robust risk management right there.
In prediction markets specifically, the speed there is just nuts.
Totally. Reached that $100 million milestone in less than a year.
Less than a year. He said it was the fastest in the company's history to hit that mark.
Yeah. It's like they spun up a brand new top-performing engine almost overnight.
And it's still accelerating.
Apparently so. Get this. Based on October volumes alone, just 1 month,
Okay.
prediction markets are already tracking towards a $300 million run rate.
300. Up from the $100 million annualized they just hit.
Yeah. A 200% acceleration in potential annualized revenue basically signaled in a single quarter. It shows the demand is there, obviously, but also that they can scale the tech, the infrastructure, instantly.
Incredible. Okay, so revenue doubled overall. What specifically fueled that huge jump? What were the inputs?
Right. The CFO kind of broke it down into 2 buckets: activity and assets.
Okay, activity first.
Activity first. Trading volumes, they were up double, sometimes triple digits, across the board: equities, options, crypto.
So broad engagement. People are trading more.
Deep engagement, too. And importantly, it wasn't just the old core stuff.
So the newer products kicked in.
Yeah, strong contributions there. Things like index options, futures. layered on top of that prediction market success we just talked about.
So the product pipeline is actually delivering, like, right away.
Seems like it. Then you've got the other side,
Huh.
the asset-based revenue, or interest-based, rather.
Right. Interest revenue. How'd that do?
Massive tailwind there. Interest-earning assets jumped over 50%.
50%? Wow. What drove that?
Primarily two things, he said. Strong growth in margin accounts and growth in their cash sweep programs.
Okay, the margin account growth. That sounds interesting. What's the story there?
Yeah, this is maybe one of the most insightful bits. Margin accounts are hitting new highs. And the reason? He specifically said it's because the company's winning larger customers and gain market share.
Ah, larger customers. That feels like a shift.
It's potentially a huge strategic pivot, right? For years, you associated the platform with maybe the first-time smaller investor.
Yeah, the retail beginner.
Exactly. But now, if they're actively winning larger customers, the kind who need and use margin, well, it shows they're evolving, becoming a more serious, maybe comprehensive financial player.
Competing for those higher asset clients.
Potentially, yeah.
Right.
And rounding out that interest picture, securities lending also hit an all-time high.
Okay. Why was that?
Benefited from a strong market backdrop, he said, especially IPO activity picking up. So they're capitalizing on those broader market dynamics, too.
Got it. Anything else on the revenue drivers before we hit expenses?
Yeah, one more piece. Robinhood Gold. Can't forget the subscription revenue.
Right. The premium tier. How's that going?
Still growing fast. Subscribers up to 3.9 million.
3.9 million paying subscribers. What's the growth rate?
Over 75% year-over-year growth.
75% growth on subscriptions? That's sticky revenue.
Very sticky, highly predictable, and it ties back to what we were saying about broadening the value proposition, right?
Yeah, things like the early rollout of Robinhood Banking, other premium features.
Yeah.
It gives those larger customers more reasons to consolidate, maybe.
Exactly. Keep more of their financial life on the platform.
Okay, so fantastic revenue story, strong diversification, solid subscription growth. Now, let's flip the coin.
Yep.
Expenses.
It's easy to just look at the shiny revenue doubling, but growth costs money. And this quarter, there were some surprises on the cost side.
Surprises,
Yeah.
okay. The CFO gave some caveats.
A few, yeah. So Q3 adjusted operating expense OPEX plus the share-based comp, SBC, that came in at $613 million.
$613 million. And how did that compare to what they'd guided for?
It was about $40 million higher than the midpoint of their previous outlook.
40 million over. So the immediate question is why? Was it uncontrolled spending or something else?
Well, the CFO definitely framed it as, let's say, a byproduct of success rather than a runaway train. But we need to look at the reasons.
Okay, here's where it gets really interesting. Why the surprise $40 million?
Two main drivers, he explained.
Okay, first.
First, because the company's financial results year to date were stronger than expected.
Right.
They had to book a higher employee bonus accrual in Q3, and that included a sort of catch-up amount for the first half of the year.
Ah, okay. So company does better, bonuses go up. Makes sense. That's part of it. What's the second reason?
The second one is kind of a fun, well, maybe not fun for the accounting team, but an interesting one.
Okay.
The stock price went up a lot.
Right. Good problem to have usually.
But that significant increase triggered the vesting of the CEO's 2019 market-based stock award.
Ah, okay. A big pre-planned award vested because the stock hit certain targets.
Exactly. And when major stock grants like that vest, the company has to pay payroll taxes on that value, like, immediately.
And that hit the books in Q3?
Yep. Booked under G&A general and administrative costs. And because the stock move was so big, the tax hit was significant and, crucially, unplanned for in the original guidance.
So stock went up so much it actually cost them unexpected money in the quarter.
Pretty much. The CFO even made a little joke saying they are through that award now.
Suggesting that specific tax hit won't happen again from that particular award.
Right. It was a one-off impact from that 2019 grant.
Okay, so those two things explain the $40 million overshoot. How does this affect the outlook for the full year?
Well, looking ahead, they're now tracking towards about $2.28 billion for the full year 2025 for that adjusted OPEX plus SBC figure.
So higher than previously expected for the full year, too.
Yes. And that reflects not just those Q3 catch-up costs we talked about, but also, he said, a conscious decision to increase investment in those really promising growth areas.
Like prediction markets again and Robinhood Ventures.
Exactly. They're basically saying, these things are working incredibly well, so we're going to put more fuel on the fire, even if it raises the full-year expense outlook. They're funding the winners.
It makes sense. Aggressively reinvesting. Did he give any sense of how Q4 started?
Yeah, just a quick update on October, the first month of Q4. Sounded pretty positive.
Good momentum.
Continued momentum in net deposits, he said. New records set in a bunch of areas. Equities trading, options, prediction markets again, margin balances.
Wow, records across the board.
Plus, he mentioned a nice step up in crypto volumes in October as well. So yeah, it sounds like the strong performance carried right over.
Okay, good to hear. So that covered the financials, the outlook.
Yeah.
But then he ended with something personal, right?
Yeah, the biggest personal news of the call, really. He wrapped up his prepared remarks by announcing his retirement.
Jason Warnick is retiring. When is that effective?
It's a planned transition for next year. He'll move into an advisory role in Q1, so start of next year, and then stay on through September 1st.
So a fairly long handover period. Seems designed to be smooth.
Very much so.
Yeah.
Very managed transition, clearly meant to signal stability, and he immediately introduced the successor,
Right. Who's taking over?
Shiv Verma. He's currently the Senior VP of Finance and Strategy and also the Treasurer.
Okay, so an internal promotion, someone who knows the ropes.
Exactly. Warnick specifically mentioned they've worked closely together for 7 years and expressed complete confidence in him. So the message is clearly strategic continuity.
Okay, so let's try and synthesize all this. We've gone through the core numbers, the diversification, the drivers, the costs, the leadership change. If you zoom out, what's the main story the CFO told here?
I think it points to a real inflection point for the company. The narrative for Q3 was, pretty simple, but also profound.
Which was?
Massive revenue growth, obviously, driven by strong trading, yes, but also those high margins. And critically, that growth happened alongside accelerated, validated diversification. Prediction markets, Bitstamp, these aren't just experiments anymore, they're becoming core engines.
Disciplined growth, basically. High growth, but managed, profitable, and strategically diverse.
Nailed it. And that leads us to the so what? Why should you, the listener, care about all this?
Right. What's the key takeaway?
For me, the most important thread through all of this is that detail about winning larger customers.
Through things like margin lending, the expanded gold offering.
Exactly. The growth in interest-earning assets, the focus on margin.
Yeah.
It confirms they are making a real push and apparently succeeding in moving beyond just being the platform for new investors.
They're becoming a competitor for more established, maybe higher net worth clients.
It certainly looks that way, and that fundamentally widens their potential market, changes their competitive landscape. It's a big deal.
Okay, that makes sense.
Yeah.
So a final thought then, something to chew on.
Yeah.
Well, the CFO mentioned their planning process, right? How they asked the older existing businesses to find efficiencies, keep cost growth really like low single digits.
To free up cash.
Exactly. They take those savings and plow them back into the high growth stuff like prediction markets.
Right. Reinvestment engine.
So here's the thought. Given the absolutely insane growth of prediction markets, triple-digit run rates, hitting milestones in record time, getting more investment this year, what specific, probably painful expense efficiencies did the other parts of the business have to find?
Like the core stock trading or the
Yes.
cash sweeps.
Yeah, to generate enough savings to fund that kind of explosive growth in the new venture, that tension. Squeezing the old core to hyper-fuel the new? That feels like the tightrope they have to walk.
Balancing efficiency in the mature parts with aggressive investment in the future, that is definitely something to watch going forward.
Absolutely. How they manage that internal reallocation will say a lot.